for tuning in to Talking Point. I'm your host, Neeraj Shah, and let's get the management of Mastek on the call today. They were expected to report, at least people who track them very closely, expected them to report a revenue number closer to about 600 crores. They've kind of done that, 581 crores, if I'm not wrong, which is a strong 5% growth sequentially. And that growth is mirrored on the bottom line as well. EBIT margins have largely stayed stable, give or take a few points here and there. The question is, on the back of closure of some deals which people anticipated that they would have done in the quarter, maybe some logo wins, and on the flip side, the worsening macro, what does their global CFO believe the company could deliver going ahead as well? That's the conversation that we'll have today with Arun Agarwal. He's the global CFO of Mastek, joins us right now. Arun, great having you. Thanks for joining in. Hope all is well.
Thanks, Neeraj. All good. I hope you're keeping good as well.
Touch wood, all is good. So the quarter seemed good for you, Arun. I mean, take us to the highlights though. I saw 5% top line, 5% bottom line, 18.5%, 19% EBIT margins, in line with what you anticipated?
Very much, Neeraj. Indeed, it's a good quarter. Sequentially, we grew by 5.4% in INR terms. And if you see the full year performance, it's really a pleasure to share it's 26.8% annual growth, FY22 versus FY21. And most important, the quality of earnings continues to be good. On a PAT basis, we have grown 32% year on year. What is more exciting that, as we promised earlier, that we are working with large orders with UK government, UK public sector. Quarter 3, we announced one of the major deal. Quarter 4 was another quarter where we have announced $65 million plus deal with UK public sector client. And that's a 3-year engagement. So large deal momentum continues to happen, and the same is reflected into our 12-month order backlog, which have grown 30% year on year. We continue to invest into our talent and then ensuring the digital talent continues to trust Mastek, continue to grow. We are seeing some tail-off happening in the attrition percentage as well, though it's early sign. We really want to be watchful for next couple of quarters. However, from the business perspective, US continues to be our focus, Neeraj, and if you would have seen the numbers, quarter-on-quarter basis, we continue to grow in US. Annual growth number is more than 50% in INR terms, which again reflect the focus which we have in the US as a geography. We continue to invest both in US, UK, and other geographies where we are present. And we believe the demand environment is good, and the momentum should help us to grow.
That's an interesting point to make, the demand environment. I mean, most people who are watchers of IT and not really practitioners suspect that could the slightly weakening macro feed in to less robust order wins for IT companies which are based on the offshoring model from the US. It's a geography that you're trying to take up to 30%, if I'm not wrong, of your overall book in a couple of years' time. Please correct me if I'm wrong, which is in the backdrop of arguably worsening macro. How do you juxtapose the two?
Neeraj, absolutely. There are certain different views which are coming on with at least growing the Eastern Europe tension which has happened. The inflation is cause of concern, no doubt. However, the IT spend is going to continue, no doubt. There are certain players who are in certain particular sectors and verticals where they feel there could be challenges. We as a company are very small in US as we speak. Our growth sector, we believe, is strongly going to be healthcare. And when we talk about our service line, we are talking about, in addition to Oracle Cloud, which is a great potential still. Not all the customers in Oracle Cloud or Oracle app has moved into Oracle Cloud, right? It's a significant domain. A lot of implementation which has been done by other partners. There's a lot of scope to get into managed services. We are seeing great opportunity in healthcare and life sciences both. We are seeing good orders, multi-year deals which is coming in our way. So with our size, there's an advantage. While there could be certain plus and minus in the geography, but with our size, we believe the demand environment should continue to be good. We continue to remain challenges to other companies. We are able to compete and we are able to win both in US and UK and Middle East as well. So we believe our competitive nature, the kind of differentiator which we are bringing on the table, will help us to grow for the next market as
well. Are these newer deals coming at better pricing? That is part one. Are you able to negotiate that? And two, despite that, because you're trying to win deals, are you being cutthroat? And could it lead to lower EBIT margins as well? It's a strategy that you could well have adopted, get your foot in the door, and then expand margins later on. Could that happen in the quarters to come? lower EBIT margins and higher deal wins?
So Neeraj, again, margins is a combination of multiple things, as you rightly said about the pricing. Yes, pricing continues to be one of the focus area. The customers do understand the rising in the input cost for the staff, the people cost has gone up significantly. There's a good talent, a shortage in the market. So our client do appreciate we are seeing uptick in the pricing as well with some of the existing client, as well as when we are going and negotiating or competing in the newer deals as well. So don't see much of the challenge in the pricing, but yes, it will be a combination. There will be certain deals where you want your foot into the door and you might want to go with the lower margin, but there are a lot of other clients, where you are mining and you believe those deals will be at the higher margin. So it's going to be a combination. EBIT percentage, we don't believe significant dilution in the coming quarter, but yes, as we are investing into the growth, there will be some dilution, but not more than 50-60 bits as we stand at the moment.
Okay, so for the year at large, you reckon that you could still be well above 18% on the EBIT margin front, console for the year?
As a target, we talked about more operating EBITDA. Neeraj, we believe 20% plus is the target we are running at.
Yeah, but EBIT margins northwards of 18%. Sorry, I'm going with that number. The EBIT margin
should be good.
Should be good. Okay. How was attrition for you? It's actually come up higher for most companies, and of all the conversations that I've had thus far in the quarter, most companies are now saying that they are probably not able to predict by when will this be contained. It is something that they're learning to live with. What's your experience, Arun?
Our experience is no doubt last year has been very high rate of attrition, unseen at least in last 10, 15 years in IT industry. However, this quarter was positively moving in the direction of pulling the attrition rate off. So we are seeing more improvement on a quarterly basis in the range of 100 to 150 pips. We have seen in this quarter itself. But it's too early to comment. As you rightly said, and as every person in the industry is saying, there's a shortage of talent in the market, right? But we expect, maybe 12 months is the kind of time it will take further to pull off. But we have started seeing the benefits of it. Different action which has been taken. A lot of people, the movement itself has been completed last year. Now I feel more of the talent will be feeling more stabilized. But yes, attrition will continue to be a little higher than our 16%, 17% LTM kind of a range. It is more 20% plus as we speak. But we believe 28, 30% kind of an LTM, which we were seeing so far, will start pulling down.
Okay. Arun, what about deal wins? I heard you use the term multi-year deal wins. And a bunch of mid-sized companies that I've spoken to say that the nature of the deal wins that they are getting are more short-term in nature, at times get finished in 6 months, at times in 3 months, at times in 9 months. So they are not necessarily multi-year deals for them. But I heard you use the term multi-year. Is that a larger portion of the deal wins that you've had? And is there something different that you're doing vis-a-vis others that you are getting those, whereas the others are not?
Yes, it could be the journey you are in and the journey the other IT companies are talking about. The journey we are in, we have been doing a lot of project-based kind of an execution, 6 months, 12 months, 2 years kind of an engagement in the past. As we are deepening our root with the existing client and mining the relationship, now we are getting into more large deals and multi-year deals. So we are in a different track of the journey, Neeraj, to be specific about. And that's the reason we are seeing customer confidence on us in terms of giving, multi-million and multi-year deals. And that's a change in profile which MASTEK is at least seeing, and we believe that the trend to continue.
So the UK side, Arun, there's no question, right? The renewals also show your strength in the public sector shows. On the US side, are you winning multi-year deals, whatever you have won thus far, or are these smaller duration in nature?
Again, there are two combinations, Neeraj. There are a lot of implementation projects which could be within 1 year, 1.5 years. However, we are getting now multi-year cloud enhancement services deal. It's a new term which we have coined because in the old model, it was more managed services. Now, customer is no longer looking only just you come and manage my show. It's more about what can you generate additionally for me. We are calling cloud enhancement services because we want to give every penny return to the customer, not just by managing their SLAs, but rather working with them together to enhance the overall experience under the cloud. Because cloud itself is changing so rapidly, right? So even you have implemented cloud as a solution, but your business model is changing, the solutions, different offerings are changing. The managing is not going to help the customers. You need to partner with them, ensure they are able to take all the support from the system to drive their business outcomes. So that's a differentiation which we have brought. And there in that space, we are seeing a lot of 3 to 5 years cloud enhancement services deal, which we are getting. And that again gives foot into the door with larger organization who have revenue in the range of $2 billion to $10 billion, and they have a good wallet share in terms of IT spend. Once you are in the door with kind of 3 or 5 year kind of engagement, now you have to get into multi-tower services. So it could be cloud, Oracle Cloud, which you are supporting for 3-5 years. But with the relationship, our target is to now go and mine and make it multi-tower services with a MASTEK bouquet of services.
Okay, well, wish you all the best for that. My final question, Arun, and that is around how do you see the next 12 months? Is it possible to see 12 months out, or are you kind of keeping the visibility now for the next couple of quarters? And what is it that you can tell us after the healthy 5.5% run rate of Q4 as well? Do you kind of continue on that path, and how far out can you predict?
Yes, we speak more internal target in terms of annual number. Quarter is every 90 days. I think all of us has to complete and report the numbers. We can't stop that, and none of you are going to leave us, I'm sure, on that. But internally, we are tracking our annual growth targets. That's how we operate, because rather than working on 60-90 days, we need to talk about 1 year and 3 years, because that's how you change the overall perspective and how you want to approach and be competitive in the market. We expect to grow definitely, and our growth expectation is in line with market. Rather, we expect to outgrow the market. Whatever X percentage market is expected, we need to cross that percentage in terms of growth. We don't share the guidance, unfortunately, Neeraj, and hence I can't give you the specific number. But as a message of confidence, definitely I can share with you and viewers. We believe the demand environment has been good. It is reflected into our order backlog, which has grown 30% year on year. One of the lead indicator, which talks about future growth as well. Definitely, we have to continue winning, continue servicing our customers. That's where all of us are engaged, and we believe we will outgrow the market in terms of IT spending.
So this is organic growth we're talking about, or would you believe that organic plus inorganic would be necessary to help you achieve this market-leading growth?
This I'm talking about organic, Neeraj. Inorganic.
What about inorganic? I mean, US side inorganic moves. Are you close to any more? Any details that you can give us?
We are under discussion with a couple of targets, but again, under M&A, unless the things happen, it doesn't happen, right? So we are under discussion. There are a couple of good assets which we have liked, but a lot of more stuff to happen before we can conclude.
So not very close. I mean, you could close it in this current year, maybe, but not necessarily in this quarter.
Absolutely. Though our hands all on the deck, saying how can we acquire the right capability as soon as possible. But the market.
Yeah, of course. Arun, appreciate you taking the time out and speaking to us today. All the best. Congrats firstly on a good show, and all the best for the quarters ahead.
Thank you, Neeraj. Thanks for inviting me. Take care.
Yeah, the pleasure was ours. Viewers, thanks for tuning in.